Howdy, Jacob here. Today we're looking at Federated Investors, ticker symbol FHI, in the capital markets industry, 3.2 billion market cap, sub 3 billion enterprise value. They're a publicly owned investment manager, and the firm provides its services to individuals including high net worth individuals, banking or thrift institutions, investment companies, pension and profit sharing plans, pooled investment vehicles, charitable organizations, state or municipal government entities, and registered investment advisors. Founded in 1955. Been around for quite some time. Revenue growth is fairly impressive for that, but also very inconsistent. So in the last 10 years, we have revenue growth as high as 23.4%, but as low as negative 10.2%. This average, though, is going to be between 5 and 7% year over year over the last 10 years, so pretty impressive. Also impressive are the gross and operating margin, but down from 10 years ago, and their return on invested capital is consistently grand. So we can see majority of their costs are split between SG&A and then cost of goods sold. Balance sheet shows 383 million cash on hand, 177 million short-term investments, which makes their cash-like products about 560 million in relation to no short-term debt and 350 million long-term debt. So more cash on hand to write off that long-term debt and capital leases, so all their interest-bearing debt, so no concern from that balance sheet. Cash flow statement shows pretty common with capital market industry companies where CapEx is extraordinarily low. Doesn't take much to just keep the business afloat. Again, that makes sense given the type of business and services that they're running. And their cash from operations is up quite a bit from 10 years ago. And so with the CapEx essentially being flat, cash from operations going up a bit, greater production of free cash flow, feel good about that. Majority of their free cash flow is going to share repurchases and a dividend, with a tiny bit of reinvestment going into acquisitions. And so, although they have a great return on invested capital historically in the mid to high teens, if you're not reinvesting it, to me, you don't deserve as much of a premium as if you are reinvesting it to get those excessive rate of returns, at least historically. And so I'm not going to be giving it as much of a premium as I would if this company were to be reinvesting everything back into the business with those historical high rates of return, but I'm ready to make some assumptions here. So for revenue growth, I think I'm pretty comfortable with the 6% or so. That's assuming some modest organic growth along with a little bit of money going towards acquisitions to improve the top line, hopefully improve the bottom line as well. 19, 20%. Let's go 20 apiece for margins. Comfortable with that. Share change, if we assume 2/3 or 50% even go to share repurchases, you're looking at about 150, 120 net, assuming all stock-based compensation go to it. That's going to be about 4%. So let's assume 4% shares being reduced. Terminal P, price to free cash flow, probably just market average here with all the amount they're giving back to shareholders, which is not a bad thing, but and then a dividend that has historically been relatively flat, so I'll keep it flat. And we're saying it's a buy right now. So this will have to be something I do further research on. Federated Hermes, FHI. Okay, so looking at 84 million. Yeah, all right. So this will be a business that I hopefully do further research on to see, whether these assumptions make sense or not. Because on initial financial review, it seems to make sense at the current price. So I'll do a deeper dive on this, and we'll see. Once I look at the quarterly reports, most recent 10K, historical P, price to free cash flows, and come up with a new valuation, whether it's still a good buy or not. Hope you enjoy the video and have a great rest of your day. Thanks.